inflation. And we're thrilled to bring you William Lee. He's chief economist at the Milken Institute, and of course, truly an international perspective, including service at the IMF. Bill Lee, Matt Miller asked a really intelligent question. Is a weak currency good or bad for your economy? Let's start with the dollar, ascendant and resilient. President Trump would have said, let's go, weaken that dollar. Is the dollar too strong as we go into this key report?
The strength of the dollar really is telling you that the U.S. is a very attractive place for global investors. A lot of money is flowing into the U.S. because this is the place where investment takes place, innovation takes place. But in terms of inflation, it certainly feeds inflation. The strong dollar is one of the things that's capping the amount of U.S. inflation. For Europe and Asia that are more export-oriented, for sure, it's going to be a weakening currency will help their exports. But if you're ECB and you're concerned about inflation, that's the last thing you really want to see is a weakening currency, the weakening euro. So it's mixed message, but depending upon what your objectives are.
You are expert on the cultural treatment of price change, the panic. We all know the cliche of wheelbarrows of Marx in Germany, but far more than that, Bill Lee, explain the cultural divide of inflation on the Pacific Rim versus inflation fears in America.
Here in the U.S., we have not had inflation for almost a generation, and we've forgotten what inflation does. And I think in what you see in Asia, where you've seen runs on currencies, you've seen crises with weakening currencies and exchange rates that are feeding the inflation in Asia. The one thing they don't want is inflation, and you see a much stronger kind of defense being put up. Here in the U.S., the Fed has got to regain its credibility that it is serious about inflation fighting, because in March, when it came out with this immaculate disinflation FOMC forecast of lowering inflation without any change in the unemployment rate, it really lost it, and the markets were pricing in 5-year break-even rates at over 3.5%. Right now, the Fed has got this hawkish talk because it really has to establish the fact that we are aggressive. We're going to be doing whatever it takes. And for currencies, as far as the currency is concerned, the speed matters. The reason why Lagarde has had almost the opposite effect on the euro from their hawkish talk is that she's giving the impression that they're going to take their time raising interest rates in Europe, whereas in the U.S., it's a clear signal from the Fed. We're going up and we're going fast.
Bill, I love immaculate disinflation. How much did China change that narrative single-handedly almost because of the lockdowns, because of the slowdown there, because of the increased supply chain disruptions that lead to higher prices and slower growth for the U.S. and for Europe?
Absolutely. So China changed the picture in the sense that we have a much longer lasting and persistent inflation than we would have had in the past. The supply chains are completely broken. It looks like, given the zero tolerance policies that President Xi has put in place in China, it's unlikely the supply chains are going to come back anytime soon. So the Fed, though, has got one objective in mind, which is regardless of where supply is, it has to bring demand down to where we can equilibrate supply and demand. So that makes the Fed's job even harder, because a lot of the things that it cannot control are pushing prices up. And it has to be much more serious about how it tackles that inflation problem. And by the way, we don't just have one policy tool now, we have two policy tools. Remember, we have a balance sheet out there, and the Fed has not really emphasized enough how strategic that tool is in being able to drain liquidity from the very hot sectors like housing and cars and consumer durables, and be able to maybe contour the trajectory of holding back demand in a way that avoids a recession.
Bill, what you just said is deeply uncomfortable, that they have to reduce demand in order to offset the dearth of supply because of supply chain disruptions. This leads to a higher unemployment rate. This leads to a deceleration that is bigger than it otherwise would be because of the supply chain disruptions. How high do you see unemployment having to go in order to achieve this dampening of demand, to bring supply and demand better into balance?
Well, Lisa, I think most economists believe the Phillips curve is dead. And anyone who relies on the Phillips curve to try to gauge the amount of unemployment you need to get disinflation is going to be wrong. But I think one of the things that we have to do is target inflation itself, regardless of where the unemployment rate is going. And that's where the Fed is essentially saying, is that we're going to try to get a softish kind of recovery, a softish downturn. And softish means a rise in unemployment rate to whatever level it takes to get that inflation rate down to 2%.
What level, Bill, do you see as being likely to achieve that?
At least another percentage point. I think right now, I think there's a misnomer that the unemployment rate is really the key guide. Right now, Chair Powell is looking at the level of vacancies. And I think that's, in a way, a mistake because there's a microeconomic disequilibrium in the labor market. There's a lot of job openings out there, but the pace of hiring has not picked up because the firms are trying to find better qualified workers, and that's really the key. And that the disequilibrium in the vacancy market shouldn't be taken as a source of inflation. I think that's a message that really hasn't been talked about enough, that the unemployment rate itself is a bad guide, but a worse guide is the level of vacancies.
I wonder what your view is on what Washington can do. As we're approaching the midterms, it seems like the Biden administration has kind of passed the buck to the Fed and saying, like, they're the only ones who can deal with this. But obviously, policies, regulations have also led to this inflation. What can Washington do? What do you expect?
Oh, Matt, you're absolutely right. The one thing that President Biden can do is reverse his policies on oil and drilling here in the U.S. If we were to turn on Keystone, if we were to turn on the ability of companies to reestablish U.S. oil and energy independence, we would be much better off. Remember, we were producing about 13 million barrels a day of oil a day, and right now we're down to something like 10 or 11. That missing oil is what's contributing to a lot of that high pricing of the gas pumps that we're seeing. And if we were to produce U.S. oil at the same level as we were several years ago, the world itself would be much better off.
Billy, thank you so much. With the Milken Institute this morning on inflation. Lisa, I want to get out front of this because Ellen Wald's going to be joining us here on oil price in a moment. And it's remarkable how Dr. Lee's conversation there dovetails with what we hear from Christian Malik at J.P. Morgan. That's just simply about bringing on investment and bringing on supply, at least as a test of these surging gasoline prices.
And we heard that in Davos. There had been such a focus on ESG. There had been such a focus on investing in greener types of fuels. But now there was a different dynamic. People were discussing the need for fossil fuels in that transition. How do you invest in both? How do you get production up in the short term if over the long term you're hoping to phase it out? What is that dynamic, and how do you create the correct incentives for fossil fuel companies that are part of that transition? And Tom, that's a longer term issue. What does that mean in the short term when we cannot get the supplies on so quickly?
Lisa's got the Hummer H2 as she fills up. It's usually on fumes, and she fills it up. It's $230.
I'm operating
Nothing like what Matt Miller's got in the driveway, which is 4 pieces of metal that need to be filled up on a regular occasion. Matt, do you see demand